So I just want to go through one last final thought with you about the portfolios. The intro offer is to basically just get each famous investor portfolio um, free for 3 months, and that includes all six of the portfolios. And then from there, you can decide whether or not you want to continue to invest or not. But once you finish the 3 months, then you'll just get an email. It'll ask, like, do you want to keep investing? How did it go? And the ones that took the free trial, they'll get first dibs on individual access to any one given portfolio, or investing in all of the portfolios at a discounted rate. Anybody else, once the free trials sell out, I've been offering it for a year. There's four left. I don't I don't know if I plan to increase the amount of free trials. I think that I've tried it and free tried it, and it's passed my test. It's passed, the people that are in my network that have been granted access of all different walks of life. So, people that have reached out to me on LinkedIn, hey, I read your paper, can I invest? Background in biology, to financial planners I have relationships with, to entrepreneurs, to family, to friends of people that got it recommended to them or stumbled upon it, or people that are part of the CMT Association that saw it through my talk on it recently. So I plan to cover as much as possible through YouTube and then through my blog, and I may post additional links there at some point in time, maybe, that'll get access to individual portfolios at the low cost rate. Say you want to only invest in Warren Buffett. I don't want to exclude you, but I don't want to convolute the site either. So I'll have to look at how I want to introduce that. But right now it's, free trial. That's the way to go. Once those are gone, you can invest in all of them. If you want to wait and just consume content, um, that might be a way to go, unless you know for sure, like, it's all the portfolios all the way, that's what I need to do, then go ahead. But I've reserved the discounted rate to those that got on the free trial first. And once they've had a chance to invest, and once the free trials are done, I may reintroduce it at a discounted rate. But um, yeah, so there were a couple other things that I wanted to talk about. Um, Basically, the regular offers on my site now. Um, the free trial gives you the offer to invest at any one portfolio at the end of 90 days. You'll receive an email with a link to subscribe to any given one. I haven't started to record the content around the famous investor, like individual. I have an AI video up that I plan to re-record to go into each one. So I think I'm going to stick with the overview of, free trial first, and then pushing to invest in all of them. But if for some reason there's just one that, like, you really want to invest in, you don't want all of them, you only want one, then let me know and I'll take a look at how I can introduce that out. So what you get with the newsletter. So let me just pick one screen to show you what you get with the newsletter, rather than show you um, a sample newsletter. Let me show you how I make the newsletter. And then that's going to be it for the beginner basics. Next, what I'm going to do is talk about the intermediate, rebuilding them from scratch. I'll make a video on how to rebuild them all, and then who it's for and what's included in the course. And then I have the course on pre-sale now, and my plan is that, once I finish building it out, then I'm going to take the pre-sale down and increase the price. So if you want to learn how to rebuild them, it not necessarily has to be reserved for fame. Hey, I'll talk about it in the video that's dedicated to that. I'm not going to go on another rant here. So let me go over that there. Let's let this finish uploading. But I guess I can tell you, like, you know, it doesn't have to be only professional money managers that learn how to rebuild them. If you are an active trader or stock buyer or somebody that's just dedicated to learning knowledge in stocks, I think it's like $147 one-time fee. And if you're already subscribing to the famous investor portfolios and you want to be closer to it, learn how to do it. Um, and then, maybe you want to add your own tweaks to it. But I'll get into that more in the video dedicated to that. You will need a portfolio123.com subscription if you're going to go that route. There's various tiers of subscriptions. I think the cheapest one is $347 a year. That'll let you put in the rules and get the passing stocks. If you want to get into more ranking, then you'll need to get the professional subscription, which is like $2,400 a year. But if it's a hobby, keep it a hobby. You don't have to let every fee bleed into your returns and run it like a spreadsheet. I mean, it's like, hey, I invest $1,200 per strategy and I pay $67 a month, but I've got, $1 million in my IRA, or I've got $100,000 in other stuff, or $40,000 in GameStop. I can invest $2,400 for the year to learn more about something as a skill. And this is a skill that I add to my toolbox. And maybe you see a creative twist on it and you want to take it in a different direction that's niche to you. Go ahead. If you want to share it with me, I'm happy to learn from you. And I believe I'll open up a community inside either the intermediate or the advanced or both, and we can share ideas. And eventually I'd like to get a podcast, and if you get it there and you want to come podcast, let's podcast and talk about it. I think that's cool. So here's the Buffett model. It's producing 6,800% return. I've modified these heavily from the paper that I wrote. So the key things that you want to look at are the annualized return. That's showing you that it's producing on average 18% per year, while the S&P is producing 7.77 over this time frame of 2000 until 2025. And the total return that's benefiting from one recession, two recessions, three recessions, and I don't know if this will be a recession or not. My recession indicator called it a recession, but we'll see. Standard deviation, we don't need to get into advanced statistics here. There's so many different people involved, but if you're curious about the term, it's just talking about, and don't shut the video off. This is not a math video. I'm not going to get into way out there stuff that you can't understand. It's just measuring the dispersion of this return. So if it returns 18% per year, then it may produce 22% more or less than that. That's what that measures. Well, how do I compare that to the S&P that's doing 7% and 15% less or more? Well, this measure here called the Sharpe ratio is taking the annualized return minus a very nominal risk-free rate like the Treasury bill, which is like 1% to 2% per year, divided by it. And that normalizes the risk to reward. Hey, you don't have a degree in finance. Now you understand what a senior level finance major would know. Sharpe ratio. So simple. So the higher the Sharpe, the better. So it's got a better risk to reward. That's how you know that that standard deviation isn't too high. But as a cutoff, you may want to have the standard deviation lower than the benchmark while the return is higher. And I'll talk about that in the capital weighted volume portfolios. I know I'm talking about three different concepts here. The intermediate course that shows you how to rebuild them, and then capital weighted volume, which is going to be an add-on, and I'll record a video on that later. But look, the newsletter, what do you get? Well, it's going to show you this graph right here. So, when you open up the newsletter in your email, you'll just see, the equity curve, and then you may see the returns. I covered this in a different recent video, but the last 12 months of returns, where the excess returns are the strategy over the benchmark. You can see the equity here. The strategy started the year at 5,900 and ended at 6,900. The benchmark started at 585, ended at 673. And then you'll get the stocks that pass. And so you'll be able to go here and you'll be able to see, like, these are the stocks that it's currently owning. These are how many shares. These are the stocks that it bought this month and the stocks that it sold. So if you're brand new starting out, you'll want to own these stocks and this many shares to invest $6,800 in it. If you want to change it, just say, I want to invest $1,000, take 1,000 divided by 10, and however many shares that it takes you to do that. If that's too hard to do, I can make a video on how to do that for you. But, if I'll try to come up with some easier ways to do it. Maybe there's a way to get like a developer tab to point and click, and if I invest, then you can just follow my investment as a separate fee. But if you're not sure how much to invest, think about how much dollars do you want to invest. If you want to talk about that, if I see it come up, I can record a video on it. But say you want to invest $5,000. Well, what's $5,000 divided by 10 stocks? It's $500 per stock. You should be able to go in your broker and say, I want to buy $500 worth of this stock, and they should be able to do the math for you. If not, ask Google. This is the price of the stock. I want to invest $500. How many shares do I buy? Does that make sense? So if you had already been invested, then if you're following it month by month, then this will tell you what stock to buy and what stock to sell. So you can adjust your allocation to match the recommended allocation. And I do that for every screen. So the last piece of information that I put out, I don't do it every time, but occasionally, instead of showing this, I'll show part of this upper graph here, which just shows you, like, over the last month, the screen did 5.29%. The S&P did 4.42. So that's your benchmark there. Over the last year, the screen did 16.88%. The benchmark did 14.42. Over the last 3 years, the screen did 115.09%. The benchmark did 69.81%. Over the last 5 years, the screen did 223.79%. The benchmark did 113.42%. Over the total time frame, the screen did 6,824.96%, while the benchmark did 573.39. That's all you need to worry about. I constantly stress test these. I'll talk about that later, but I go through and I make sure that, it's able to hold up over multiple time periods and that it consistently works over multiple time periods, because that's the best indication that it'll keep working in the future. And then I go through and I, update it regularly. So my goal is to invest in these over the next, at least 1 to 5 years, if not 20 years or longer. And I don't want to wait 20 years and go back and wish I had. So that's where, I'd like to make them available for people to invest in. And that's what you get inside the newsletter, and you get it for each one. So for Buffett, you get it. For CanSlim, you get it. For Greenblatt, you get it. So when I talk about rebuilding them from scratch, I'll go through and talk about, like, how do you look up a famous investor? How do you learn what their rules are? How do you take their rules and put it into a screen formula that the portfolio 123 can learn? And then how do you stress test it? How do you look at multiple time frames and make sure that it's going to hold up? How do you add your own criteria? How do you use ranking systems? How do you take the ranking systems that are in portfolio 123? How do you modify them to make them your own? How do you change the frequency up? So if you ever want to add like, capital weighted volume to it, then you probably want to start here. This is the Greenblatt portfolio, same concept. But if you're a broker and you want to add this to your mix of client portfolios, but you have tech savvy people in your brokerage house that may understand these rules and then may understand other rules, and you want to combine them, then this is how you do that. And it's a low cost fee. So there's some variability, which is where I think these start to complement each other. But same thing. You get the graph, you get the returns over the last year, you get to see what stocks it's currently invested in, and then what stocks it bought recently and what stocks it sold recently. And so the same thing, you just decide how much you want to invest. At some point, I'd like to look at the trade-off between, which system invests in what time. For example, this did really well over 3 months, but not so well over the last year, but it's done great overall. So, different market conditions are going to affect different stocks. And, um, in the course where you rebuild it on your own, then I'll go through the rules of each one, which are in the paper, and show you how to rebuild it. And then that should help you if you want to learn more about it. But what you get is you get each portfolio sent to your inbox each month for the S&P 500 and for all available stocks. And then from there, you're given a schedule. So like it'll send you a new one every 4 weeks. And you can just follow it in your account. And it's as easy as that, but you might want more. You might be the type of person, well, okay, I've been following Can Slim, and I've been following Buffett, and I've been following Graham, and I've been following Greenblatt, and now I'm following them on the S&P 500 too. And well, I'd like to learn more about them, and I study this stuff through you, and now I'm going in and I'm looking at the course on how to do it. And I'm, going through and I'm rebuilding the rules alongside you. And oh, well, I'd like to know how I can add dividends to it. Maybe you like those rules better. Well, then you can update your own, or you can follow mine and update your own, or you can, talk about it in the community, or come on a podcast and talk about it, or share with me what you found and we can go over it together. Um, so yeah, they all do the same thing. Each one has its own unique set of rules. The rules I got out of the Can Slim, out of the book How to Buy Stocks by Bill O'Neill, the Buffett out of his book, which I don't have in front of me, I have it at home, Graham, his book also. And I started with American Association of Individual Investors, and then I looked into Portfolio 123, and I started to learn what had already been made on these portfolios, and then started to revise it. And so if you're a novice beginner, you don't need to go this far. I'll just do this for you. But if you're somebody that wants to learn more about it, or wants to have more control over it, or wants to walk their way up to, totally understanding it, to where in the advanced tier we go through Bloomberg and Python together and how to do it in the equity screen in Bloomberg, then this will get you there. You'll walk your knowledge up. But like, look, so we sold SIBO, we sold DoorDash, we bought PLTR, we're holding Sativa, DE. Some of these stocks I don't know what they are, and I know what a lot of tickers are, but from what I find, like the Can Slim system, it almost always exposes itself to the stocks that are, in the hot sectors, in the hot products and services. The simplified Can Slim, this one is like more bare bones Can Slim. And so I'll break this down in the course, but like it's not giving you all the full Can Slim criteria, but it still does really well. So if you look at it like, over the last month, it doesn't do that great. And over the last 3 months, it doesn't do that great, but over the last year, it crushes it. So compare that to Greenblatt. Greenblatt crushed it over the last 3 months, but didn't over the last year. So you could start to put these strategies together and build a portfolio. And then, your average return might, be 5% a month more than the market on average, or a year more than the market. And once we get into looking at options and technical analysis, we can start to make some of these stocks picks stand out and make a more tailored approach by reducing risk and increasing the returns. So, yeah, I like these a lot. Over the last 3 years, over the last 5 years, total return. We can look at one more screen. I also have a screen that's only technicals. It's called VPCI, which is a technical indicator that incorporates volume and price momentum. And I added it to every famous investor portfolio, but I also made it its own portfolio. So a lot of the stocks, they pick up on similar information as each other. And so, like, some of them pick up on the same information as others, some of them don't. I like it when it buys and sells names I'm familiar with, like Lululemon, Deckers, Ulta Beauty, Applied Materials, Chipotle. It's buying. Here it's buying SIBO. The other one was selling it, so that's something to consider. But it owns Doc, it owns Fang, it owns Into, so owns Now. We're going to look at how to break these down more, but not in the intermediate course, not in the beginner course, not in the advanced course. That'll come out later, and it might just be something that's a more optional add-on that combines technical analysis from day trading. I'll teach the basics of technical analysis in the day trading course, and then more intermediate breakouts. And then I did get a request to look at options and futures, so I'll look at technical analysis for options and futures, and then I want to go through the technology from my dissertation and apply it to, looking at the passing stocks as well as day traded stocks and options and futures, and um, might be able to combine some of those things in a more premium course, but should provide the bang for the buck. So once I start to work with it and once I start to use it and I feel comfortable with it, then I'll introduce it here. It might be more than a year out. It might be sooner, or up to a year out. Like over the next year, I'll work on doing it. I want to work on the day trading content now, but here's a preview of what's in the newsletter, and here's a preview of what is, going to be available in the intermediate course. But you can see, VPCI does really well over 1, 3, and 5 years. And so the newsletter breaks you down, what stocks do you want to be invested in and when, and then how to buy and sell. And then, if you like Graham style of investing, maybe you just want to invest in Graham. If you like Buffett, maybe you just want to invest in Buffett. If you like Buffett and Graham, maybe you want to invest in Buffett and Graham. So yeah, that's what these are going to tell you. It's going to tell you what stocks pass and when and how to update it, so you can, follow the recommended portfolio as it updates in real time. And so yeah, these are totally different stocks now that we're incorporating value, different from the growth. And so, again, we can see it does really well over a month. So that would complement the simplified CanSlim really well. So my recommendation is, open one account per strategy. So open, 6, 12 Robinhood accounts and, link them to your account, and then each account can have its own strategy. If you want to invest in only one or two accounts, only open one or two accounts. Which one didn't we look at yet? I think we looked at just about all of them. So I did skip a few, but I forgot to save the log here. If I click save log, will it save? I don't know. Let's just give it a minute to update. Almost done. So here's the VPCI. I've already explained, what these do. So if you want to go through it, you can pause the video and go through it, and then you're familiar with these graphs. So that's what you'll see in the email. And I've broken down these terms already. The about is where I like to look at, because like here, this one doesn't do as well overall, but look at the last 3 years. Look at the last 1 year. Look at the last 3 months. So at any one point in time, one might do better than the other, which is why, you may want to be exposed to all of them. So I plan to invest in all of them. I had stopped investing due to the recession rule, which is what I cover in the Ludi Recession Indicator. And that basically just looks at, what prolonged period of interest rate inversion has happened. I'll break it down in its own video separately, but just to give you an overview, it looks at like the very simple terms. This is where we want to get out of the market and stop investing in the portfolios. And right now, even though the market is headed up above where we got out, and I had indicated previously that that might happen, we're still going to stay out and we're just going to watch until October. That's the basic rule. The intermediate rule is going to be, how do I add these lines on the chart and learn and understand what they mean, and what is the signal? This is known as the death cross. So it'll take you a little bit beyond the beginner. Um, and then I'll, put some free content out about understanding, the yield curve rule, but I'll probably put that also in the beginner course as well, just so you're familiar with it. But all the beginner course is going to do is tell you where to get out and where to get back in. The intermediate course will have you start to rebuild it, but mostly focused on the death cross signal. And then, um, I'll help you understand what, when to get back in. But, it's more for client portfolios and, active investors. But if you understand the death cross signal and you know where to get out, that's step one. Getting back in the advanced course, I'll talk about, how to look at the prolonged period of yield curve inversion, where to look up that information, how to understand how long the yield curve has been inverted, and how to apply it to the rule. And then looking back here, as the market went up, we saw there was a period of declining volume at a late stage. As the market went up, the volume declined. And at the same time, in the advanced version of the course, I'll talk about like how to understand what sector you want to be invested in. And this is way more info than you'd probably ever expect. But if you're a beginner and your head's going, what is going on? That's good. If you're advanced and you're with me all the way, that's great. Knowing that, as the market's going up and the volume's declining and financials are leading the market, that's a good indication that it's ready to sell. Knowing that technology was leading here and it's lagging here, that's a good indication to sell. So that's a good time to get out of the portfolios, but you don't have to, because from the research I've done, even during these steep sell-offs, the portfolios still tend to beat the market. At least canceling does. So I'll show you in the intermediate course, like, when you want to take this death cross signal to get out and when you don't, which is combining the death cross with prior periods of yield curve inversion. And in the advanced course, I'll talk about like how to understand what stocks are leading the market, what stocks are lagging the market, how to combine that with this signal, ongoing market commentary related to the current market, and then more advanced technicals. So like, the rule says to stay out till October, but are there any technicals that we could use, back here that would, negate the rule? Or can we do some sort of allocation, like, reduce exposure 50% on the death cross, and, Um, when it makes this V-shaped recovery with this sort of, sell off and then retest, which is a bullish pattern as the average directional index is maxed out, it, that could be an indicator to add another 25. And then when you have, the market test the moving average, or you have the golden cross happen, then you might want to add another 25 and be 75% exposed until the signal dries up totally. Or you want to go back to 100% after you have, the golden cross and this retest. But in the past, um, you can see that COVID sell-off, we had the same signal. We had a death cross and then a golden cross. And so maybe, the V-shaped recovery and the golden cross should negate the signal. But let's look at, all the other recessions, because the death cross and the golden cross by itself isn't really a good standalone tool. The death cross, like 2008 that happened here, that's not a golden cross you want to take. But as it makes a lower low and the indicator makes a higher low, that's really good bullish divergence where you can say, now it's time to get back in. But this recession, the date of the recession and the Ludi recession indicator are almost spot on. These later recessions like COVID, that's driven by, a global pandemic, which is a quick V-shaped recovery, and this, which hasn't been labeled a recession yet, which was driven by tariffs. There's still a lot of uncertainty right here, as there was back here. So if you want to be as safe as possible, just wait till the recession indicator to dry up, which I think the recession indicator dried up in June. So, if you took the golden cross, you could get back in on that. Or you could be safe, and when the recession indicator dries up, you miss out on some gains, but you're protected, and then you don't have to worry about what happens in 2022 and worry about all these death cross and golden crosses. You don't need to worry about them because there was no interest rate inversion. The only time there was interest rate inversion since COVID was from January of 2024 back here. And you don't need to take these signals. I'm sorry, I don't have the right indicators on. It's not 9 and 21. It's 21 and 200 or 250. So here's your death cross. Let's do 200. All right, so there's your death cross. So there's your golden cross. Here's your retest. So the thing is there's so much uncertainty here, the market could come back down to here still between now and October. So you may not want to get fully invested yet, which is why I'm still following the recession indicator. But during COVID, it sold off. You had a death cross here in March, which was where the recession indicator triggered it, had the same V-shaped recovery, although the indicator didn't give you the fake out, only price did. But you can kind of test it here on the stochastic. I'll break this stuff down in a separate course, but the golden cross in June is about where the recession indicator dried up. But there was no recession here. There was no yield curve inversion, so it didn't trigger anything. So you just held through this in 2022. So here, when the death cross happened and it said, here's the recession start, the length of how long the yield curve was inverted for would have you out of the market till this fall. So you got out here, you saved yourself this, you're missing out on this, wait and see what happens. If it continues to rise and rise and rise, eventually it'll retest. It'll probably retest around here, and maybe that'll happen around October. So you understand what you get with the portfolios, you understand what you get with the recession indicator. In the advanced course, we'll talk more about sector timing, more advanced technical analysis, possible allocations for the recession rule that you can apply and maybe come up with, more comfortable sell-offs, such as, the market's rising while financials are leading and volumes declining. Let's reduce 25% here or 50% here. Let's reduce the other 50% here. Here's a nice retest and V-shaped recovery. It's mostly tariff driven. Let's add back in 10%, 20%, 25%. Here it takes the moving average. Let's add another 25%. Let's go back to full exposure on the golden cross. But your risk is that, you're allocating through these periods. The market still has between now and October, based on the recession indicator, to do whatever it wants. And the recession indicator would say, if there's a new death cross, follow it. If there's a new period of interest rate inversion, follow it. So we don't know what's going to happen yet. So it's sort of like you have to figure out how much risk you want to take. Hope that helps, and hope it, interests you in some of the other things that you might want to learn about.